All right. My name is Yasser Ali. I'm the founding attorney here at the firm, and our firm is focused on wealth planning. So wealth planning is really thinking about the preservation and transfer of wealth. That's what we do. That's the only thing we do. So think about protecting your wealth, preserving your wealth, transferring your wealth efficiently in your life and after you die. So that's what we do. A big part of what we do is a charitable planning, and we've structured over $100 million in charitable gifts and bequests. So that's something amazing that we do. And it's really a fulfilling part of the work. And we have a bunch of years of experience. With me today is my colleague and my law school classmate, Aboud Shabalut, who I'm very excited to have join us and who's been working with me here at the firm. So I'll let you introduce yourself.
Assalamu alaikum, everybody. My name is Aboud Shabalut, and as a former classmate of Yasser, I can attest that he was a great student. A little bit about myself. I'm an estate planning attorney, which basically means I do trusts and wills for families across the country. And I also do trusts for high net worth individuals. And I also a startup guy myself. And as a result, I do a lot of business law. And I've been working with Yasser for some time now.
So we're going to talk tonight about, you guys have perhaps attended different programs that we've hosted. We've actually never done a webinar, by the way. So this is our first one. So forgive us if, there's a little bit glitchy. We're late to the Zoom webinar world. We try to do everything in person. So we love meeting people, conversing with people, talking to them about how to protect, plan their wealth and for their families. So tonight we're going to talk about a narrower topic, which is end of the year tax strategies. And anytime you work with a lawyer, as you know, there's a whole bunch of disclaimers. The disclaimer here to start with is that the contents tonight are general in nature. So it's not particular legal advice. Even if you're a client of ours, right? You're not an existing client for the purposes of what we're going to talk about today, unless you want to engage us to do some additional planning for you. So to get that out of the way. Secondly, everyone's situation is unique, right? So the things that we're talking about, you have to take into context your particular situation. Again, some of this stuff comes with consultations and teamwork. So we want to work with your CPA and in a collaborative way to make sure that the strategies and techniques that we're going to talk about today are applicable and effective and beneficial for you. That said, we're not CPAs ourselves. We're lawyers. We're wealth planning attorneys. We do tax strategy. We don't prepare the taxes. So people have to understand the distinction, right? You can't call us afterwards and be like, file my taxes next year. Like, we can't do that for you. And also, this is an hour. So we're going to cabin this to 1 hour. And so naturally, we're not going to be able to talk about everything. So you might be wondering, well, how come you didn't address this technique or that tool or whatever? The frame really here is we're not going to talk about the most basic things that you should already know, or that perhaps your CPA told you, or perhaps you can easily find on Google. So we're going to talk a little bit more about some advanced strategy and planning. Hopefully, you will find it beneficial, interesting, and be able to apply some of it in your life. So, as we said, if we think about, we're at 6:08. We want to be respectful of everyone's time. We know it's the evening. A lot of you are joining from the East Coast, which is really cool. A lot of you are getting off of work in California, where it's 5 o'clock, maybe driving home. And if you're in Arizona, it's, you're waiting to go home and eat dinner. So we want to be respectful of your time. We're going to try to finish it at 7, but we can also stay a little bit later for additional questions if you have additional questions, but we'll end officially at 7. So we're going to talk about ethics and objectives. Like, is this stuff we're talking about today legal? Should we even be talking about it? Give you a little bit of, tax law jargon so you understand the language, because anytime you're trying to do something, you have to understand the language. And then we'll talk about strategies, scenarios that hopefully, as we said, will apply in your unique situation. And then we'll take Q&A. And like I said, you can ask the Q&A throughout, and Aboud or I will be monitoring this thing.
Yeah, and I just sent everyone a message. I opened the chat to everyone, so feel free to put your questions there, and we'll try to get to them in the end, inshallah.
Awesome. So the first thing is like tax planning gets people a little nervous, right? So what do you think of when you think, tax planning? Like who comes to mind?
Um, Many things and people come to mind, but the first and foremost, Donald Trump himself.
Right. So like, you know, it's interesting. Like Donald Trump says, I'm smart because I didn't pay taxes, right? And to a degree, right? To a degree, the frame that he presents is true, right? Except he took it to an extreme of where, his company's convicted of tax fraud and all of that, right? So there's tax planning and avoidance, which is legal, and there's tax evasion, which is illegal and lands you in jail. Okay. And there's a whole bunch of celebrities and famous people who end up in jail for tax evasion. And so one way to think about paying less tax, because this is a self-reporting regime, right? The IRS isn't going to give you money back unless you ask for it. That's the way that the IRS works. And in fact, it's really interesting. I was looking on the IRS website today, and they have something on the website, which is a handout you can download, and it says, quote, many people pay more federal income tax than necessary because they misunderstand tax laws and fail to keep good records. So this is really important. Like there's no patriotic duty. There's a famous judge who probably had the coolest legal name. His name was Learned Hand. If you're a law student and lawyer, like you had read many of his cases. So Learned Hand essentially says the same thing. There's no patriotic duty to give more. It doesn't make you a better sort of American by overpaying when you don't need to. So that's the frame that we're going to talk about. We're going to talk about utilizing legal techniques to lower your taxes that are present in the tax code. We're not going to talk about things that are, super audit risky. We're not going to talk about things that are just straight up illegal, right? That's not going to be the frame that we're talking about today.
Even if I may just interject, even the framing of lowering your taxes, sometimes it's actually not necessarily about lowering your taxes. It's about making sure that you're not paying too much. And the IRS is built in a way that incentivizes certain actions. And oftentimes understanding what those incentives are, while the result might be you have lower taxes, it's you're just taking advantage of what the government is telling you could take advantage of. So it's just it requires a little bit of planning and just some understanding of what those incentives are.
Perfect. I think that's helpful as well. We're going to talk about the various sort of techniques, not just lowering. So framing is important. I would, if you can, enable the chat. It seems like it's still not able for some of these comments that are in the Q&A rather than in the chat. I don't know what the real difference is between the two, but you can keep asking questions in Q&A if the chat for some reason doesn't work. So actually that actually leads really well to the concepts that we have to understand before we dive deep into the weeds of the various strategies, which are, there's three different things here that you can do when you're thinking about planning. And planning is the operative word, right? Because, we plan for everything. And so with a little bit of planning, you can achieve these results. The first is to reduce your taxable income. So some of these strategies are aimed at reducing your taxable income. So what do I mean by that? So there are deductions in the tax code that you can take. And what that does is that lowers your taxable income such that you necessarily will pay less and owe less to the government, right? So some of these strategies, and some of these we already know about, right? Anybody who pays taxes understands what a deduction is and might have some idea of what a credit is. So some of the strategies are focused on reducing your taxable income, which will result in a smaller liability. So that's like, the first concept that's important. The second concept is to reduce the tax rate that is applicable. Okay, so what I mean here is, let's say there's $100 of income. That $100 could be taxed at different rates for a number of different reasons. The most obvious of which is converting or is the fact that the government treats capital gains, long-term capital gains, at a different rate, a lower rate than ordinary income. So some of these techniques are going to be intended to kind of convert the rate from ordinary income into capital gains, or by lowering your bracket, you also lower your rate. So again, if you, and there's a lot of people from all over the country at different levels of complexity. So some of this stuff might be review and some of it might be new, but there's different tax rates. The more you make, the more tax, the higher your rate, essentially. And so what that means is if you can achieve A, you might also then achieve B. So by lowering your taxable income, you are now in a lower bracket, thus you lower the tax rate as well. So this is another technique that is some of these tools are aimed at. And then another one that people don't think of too much, but is equally important, is a concept of deferral. So it's not necessarily I want to pay less in tax or A or B, but it's I'll pay it later. Okay. So, and this is really valuable because what that means is the IRS is essentially giving you an interest-free loan. Right? So as Muslims, we try to avoid interest. Here, the IRS is basically going to say, you don't have to pay us today. You can pay us in 5 years or 10 years. So what do? You basically take the money you would otherwise have paid the government and you do something with it, right? You invest it and you grow it and you do whatever you want to do. So it's like taking out an interest-free loan from the government. So a tool. And the fourth one, perhaps that's not on here, but I think is just worth at least flagging, is the concept of basis. So there are some assets you have when you purchase an asset, for instance, like a stock or a building, an apartment, whatever, it has a basis. And that asset's basis, when you sell it, is going to determine how much you owe or in gains or losses. So some of the techniques are designed to sort of adjust or readjust the basis so that you either will pay less or more. Obviously, we're trying to go with less in taxes ultimately down the road, not today, but when you ultimately sell the asset. Does that make sense, Aboud?
Yeah, and not only does it make sense, but I just want to underscore the importance, if you can go back up to the slide that you're on, the importance of these concepts. They're not just concepts, but these are actually the drivers of these techniques. And once you understand these concepts, then you can begin to really be the maestro of your own planning. So like literally most all the advanced most all basic and advanced techniques are being driven by one of these items on the screen right now. Before we go to the next slide, I want to frame some of the techniques that we're about to share. When we think about tax planning, we like to think about 3 different scenarios that you might be in. Scenario number 1 would describe a year where your income is below average, meaning you're making less money than you normally make. An example here could be, and this is it is a somewhat of an extreme example, is that you may have had a business and you sold it last year, but you're still on vacation this year, and as a result, you're not making much money. You're still wealthy, you still have money, but you're not generating income because you still haven't either started a new business or found a job or whatever your plans might be. So this would be a below average year financially speaking. The second scenario that we think about would describe a normal year. An example here would be you're still employed, alhamdulillah, and you're collecting the same check that you've always collected every single month. The third scenario describes a year where your income is above average than it usually is. So here, an example would be you received a bonus that you don't normally see. Maybe you made an extra $100,000 this year that you don't normally make. So this would be the third scenario. And when sort of wrapping your head around these scenarios, it's important to understand that they're not mutually exclusive. And let me give you an example of that. You might have an above average year financially because you received a large bonus, that $100,000, for example. But maybe your stock portfolio is down, like really down. So in one area you're up, in another area that you're down, and therein lies more opportunity to kind of take advantage of certain techniques and tactics. The other thing that I just want to kind of underscore before I go over the first technique is that it's important to overlay your personal goals. Are you looking short term? Are you looking long term? And once you have a clear line of sight about what your goals are, it'll allow you to make decisions about what you want to do. So ironically, it might lead you to make a decision where you are going to purposefully and consciously pay more tax this year so that you can have an asset tax-free 20 years from now, 30 years from now, for example. So your personal goals are important as well. With that said, let's move on to our first technique to think about. Yasser. Okay, thank you. So in a down, let's go scenario by scenario. So in a down year, either you're down on everything, or maybe you're down in either assets or stocks. A good strategy to think about is something called loss harvesting. And what loss harvesting is basically taking advantage of a loss to offset a gain. So an example of this could be you sold your Amazon stock at a $40,000 loss. That loss could be used to offset a gain. Maybe you sold the business or something. You sold something else, and you can reduce your taxes that way. That one is easy, and that one's obvious. I'm sure everybody knows about that. Now, what's interesting,
I think the only reason we're flagging this is because some of these are somewhat counterintuitive. Like when you're down, you don't want to admit you're down, right? Like you're like, so sometimes it's advantageous to go ahead and take that loss to, offset a gain that you might be able to take. I think that's
great point. And that actually, that's perfect, because it leads me to another concept here, which is something called the wash sale rule. So what people would do to basically take advantage of what Yasser just mentioned, and I just to describe it in a different way, is let's go back to my Amazon example. Let's say your Amazon is down $40,000, and you haven't sold it yet. But what you might want to do is just sell it on purpose, just so you can realize that loss. So there's something called the wash sale rule, which basically, sorry, let me take a step back. What people used to do is they would sell it just to realize the loss and then rebuy it immediately to keep holding the asset. And what the wash sale rule says is that for stock or for securities more broadly, that's no longer allowed to just sell and rebuy immediately. You'd have to wait 30 days before being able to buy. With crypto, however, herein lies another opportunity. With crypto, you can actually buy it back immediately, because the IRS does not consider crypto to be a security, at least not yet. So just as an example, let's say you bought one Bitcoin at 60,000, and then I'm just going to use easy numbers. It's now 20,000. You can sell it on purpose to get a $40,000 loss and then rebuy that Bitcoin immediately. And all you're going to lose in that process is the transaction fee. But what you now have is $40,000 that you can use to offset gains you might have somewhere else in your wealth kind of inventory, so to speak. So a couple things you can do is you can offset up to $3,000 of ordinary gains. These are gains maybe that you're receiving through your work if you're a W-2 salaried employee. And what that'll leave you with is $37,000. And you can roll that $37,000 onto future years indefinitely. So you can keep using it to take $3,000 of offset $3,000 of gains every single year. Now, a more advanced strategy would be is you have this 37,000 of extra losses, but you want to take advantage of it this year. So an advanced idea here would be to go find an asset, preferably stock, where you're up $37,000. And in that case, purposefully sell that, the 37,000 gain from that stock, let's just say it's Apple, is going to offset the 37 loss from your Bitcoin will offset the 37 gain from your Apple. And basically what you're going to do here is do something called a resetting of basis. So now your Apple basis is going to be higher. And when it's higher, that would mean that you're going to pay less taxes in the future when you actually want to sell Apple to take advantage and take those profits. So let me just say that just one more time, because I as I'm describing it, I want to make sure I articulated that properly. So you sold Apple at a gain of $37,000, and then you rebuy Apple immediately. Your 37,000 of Bitcoin will offset the 37,000 gain on Apple. And then let's just say a year from now, you go ahead and you sell Apple for something more. The profit on paper is going to be less, which means you're going to pay less tax. But in reality, you're going to save on taxes because this year you reset your bases. If you have questions about that, just email us afterwards or ask in the chat here, and then we can kind of go over it one more time. So that's another step.
Just one real quick key here is this rule is likely not going to exist much longer. So that's like if we're talking about year-end strategies, this crypto rule, it was supposed to be overruled in the Build Back Better bill, I think it was called. So they specifically wanted to eliminate this loophole. So this is a year where, like, if in the last couple of years you bought crypto at when it was much higher, this is an opportunity that is present that might not be present in next year if the rules do change. So this is one that very likely the law will change on this point. So
yep. And then I see, thanks Yasser, and I see a question here about short-term versus long-term capital gains. It's actually a very good question here. Yes, when you reset your basis, you're resetting the time on that. So if your goal, going to my example, you sold Apple at a gain, but you're not, and then you rebought it, right, to reset your basis. If your goal is you're going to take the profits a few months from now, just know now you're going to have short-term gains on that. So you got to run the numbers and make sure that is gonna work for you. Otherwise, but when you reset the basis, if you want long-term gains, you're going to have to wait a year from when you reset the basis. Great. So I'm going to jump to the last sort of down year strategy here that we want to talk. These aren't the only ones to think about, but these are the ones that we think are interesting. Is something called a Roth conversion. So this one's a little bit complicated. I'm going to try to say it succinctly. Basically what a Roth conversion is it's when you are going to consciously and purposefully convert an IRA into a Roth IRA. And just to, just in case, just to summarize what the difference is between a Roth IRA and a regular IRA is, a regular IRA is a retirement account where you put pre-tax dollars in today, and then you wait until your 60s before you can touch it. And when you liquidate any of that stock, you will pay your tax then. Okay. So here you're deferring tax. You're taking a deduction today, but you're deferring tax until a later time. A Roth IRA is the opposite. A Roth IRA, you pay your tax today, but for the promise of not touching it until your 60s, the IRS will let you liquidate it tax-free, but you have to pay your tax today. Now, in case you have you're remorseful of your original decision of picking an IRA versus a Roth IRA, the IRS actually allows you to do a conversion. You can actually, even though you may have set up your IRA 5 years ago, you can actually convert it today. This is allowed. Now, if you convert it today, you will have to pay tax today. So let's use an example. Let's say you have a $100,000 IRA portfolio, and let's just say you're making more than $1 million. You're in the 50% tax bracket. I'm just making numbers very easy here, so you can apply it to your own tax bracket. So your 50% tax bracket applied to this IRA portfolio, if you choose to convert it this year, you'd have to pay $50,000 in taxes. Okay. Not a good idea. This is not something you do when you're up. And hence why we're including this in a down year strategy. Ideally, you do a conversion when your income is down and your stock portfolios are down. So let's just go back to my original example of a down year. You sold your business last year, and this year you're not making much money. And let's just say your portfolio is down 50%. So now your 100K IRA portfolio is worth $50,000. And let's just say because your income is down, you're now in the 15% tax bracket instead of the 50% tax bracket. Here, you'll pay $7,500 to convert it versus the $50,000 if you converted it into an up year. So you pay the $7,500 this year. And now, inshallah, the portfolios will recover and it'll even grow from there. And you probably expect that you're going to be in a higher tax bracket when you're retired. So inshallah, this 100K portfolio is going to be $600,000, for example, when you retire. All of that will be tax-free. You liquidate in retirement, 100% tax-free. So this is an extremely powerful strategy, but very important to only do it in the down year, and you're going to have to run the numbers. If you're close to retirement, it may not make sense, but it might if you're really, really down. So this is one of those things where you also have to factor in how many years of growth you still have left on your Roth once it's converted. And with that, let's move on to the scenario number 2, which is you're financially where you normally are every year. And Yasser, you want to take over here?
Yeah, before I do that, there's a couple questions. So this is available to everyone. The Roth funding has income caps. Like, you're not eligible to set up the Roth, but you're eligible to convert the Roth. So you're going to realize the gain. So if you're going to pay the government tax, they'll take your tax, right? So you can set this up. Again, it's not going to make sense for a lot of people, but you could do it. So really, it's a strategy. And most people do tax planning after the fact, or they don't do enough, or they do it in like really good years. And so all we're doing here is just trying to educate you about possibilities exist even when your portfolios are down or income is down. Those are potentially opportunities to plan as well. So let's go then to like the average year. Now, remember, when we use the term average, we're talking about like your average, right? Because everyone's average is different. So in any normal year for you, you have certain things that you can do to sort of, again, go back to those original concepts we talked about, to lower your taxes, to lower your rate, and to defer taxes. Some of these are some opportunities are greater for business owners. So if you're a business owner, for instance, you can defer your income to next year. So that's, if you're not a business owner, you can't tell your boss, like, don't pay me, just pay me in January, right? Like, it's not going to work, right? You got to get paid. But if you're a business owner, you might be able to tell the client, like, hey, let's take this in January. You can also accelerate deductions, right? Things like expenses that you have, right? So a lot of CPAs, and there's the famous Hummer credit where you can go buy a big car that you don't need, or some office equipment that you don't really want, things like that. Those are like things your accountant is probably explaining to you. But the concepts are important to understand, that if you have real expenses that you're going to spend in January, February, spend them now, right? Because that's going to lower your taxes, your taxable income. So it's called accelerating deductions or deferring income. Now, the same concept applies with charity. And at our firm, like, charity is a big part of what we do. So advanced charitable planning. So, if you're somebody who gives every year, good years, bad years, you have, zakat obligations, sadaqah, there's tithing, whatever the case may be, where there's annual obligations for charity. And even if they're not obligations, you're just a charitably inclined person, right? So then there's opportunities where you might be able to do what's known as bunching. Okay. And bunching applies not just to charity, but to any type of itemized deductions. But we're going to talk specifically about charity, and we're going to focus on charity because, our community is very charitable. but I don't think we're very smart with respect to how we give. And what I mean by that is, for instance, to take a few examples, somebody who gives $10,000 to $15,000 a year in charity, I mean, that's a lot of money. That person very likely today would not be itemizing on their taxes. Okay. And I know we're talking a lot of like accounting language and stuff, not like pure law, but the concepts are related. So kind of stick with us, right? So if a person donates 10, 15, $20,000 a year and they're below the standard deduction, which next year is going to be $27,000 for a married couple. That's a lot of money. So if all of your deductions combined come out to less than $27,000, you're going to take the standard deduction. If it's greater, you're going to take your itemized deductions. And so what a lot of people don't realize, and we've got a lot of people from different, masajid and religious organizations on the call as well that might be on boards. So this is something to think about as well when you want to advise your constituents in a more, educated manner. If you bunch the deductions, maybe you itemize every other year. So you give a bunch of charity this year, and then you skip next year, and then you give the year after that. Well, you might say, yeah, so that doesn't make any sense. Like, I give every year, so how can I give it all in, year 1 and 3 and 5, but not years 2 and 4? So again, there's tools for those things, right? The most common of which you might be familiar with is a donor advised fund. So donor advised fund is like, a bucket or a sadaqah jar that you put your money in, and you then contribute out from it. But you take the deduction in the year you put it in. So, like for our kids, you tell them like, put money in the donation box. And you have one, a lot of us, we have a donation box in the house. And so you tell the kids to donate to it. And then at some point you're going to go out and give the money out of the box. Abud, you got one?
Yeah.
That's that one up, man. So from that, it's essentially the same concept, right? Put it in this year, take the deduction, and then in subsequent years, you can then donate to the specific charities that you want. Okay. So that concept is known as a donor advised fund. And that's something that a lot of people utilize to sort of optimize their giving, because maybe you put in $40,000 or $50,000 this year and you use it for the next 2 or 3 years. And then in 3 years from now, you put another $40,000 or $50,000 in. But the thing is, you'll never get the money back. So once you put it in, you take the deduction this year and then it's gone. It's charity money. So if it grows, again, it's going to grow for the charities. It's not going to grow for you. You take the deduction, and of course, you get to benefit the charities that you were going to benefit anyways. So that's just one example of smarter giving, right? Making this promise to give, the IRS will reward you, and not just with the promise, but you actually put it into this container known as a donor advised fund. Does that, Abu, do you got anything to add here on the average year? Or should we move to the exciting stuff?
Well, we have Abir asking, Zakat al-Mal is annual, so how can we use this bunching concept? Abir, we'll get to that right now in this next technique, which solves for that.
Very good. Yeah. So this was exactly the question I was making, right? So you say, okay, how, it doesn't make any sense. Like I want to give every year, right? So the question is, I need a tool that allows me to donate, take my deduction this year, but then still make the donations in subsequent years and have them count for the religious purpose, right? So we're going to talk about our favorite tool, my favorite tool, in a good year. Now, again, remember, it's 1 hour, and we could talk about 10 different things here today. Like we could talk about charitable remainder trust. We can talk about a whole bunch of different advanced tools, but we picked just a few so that you can hopefully digest them and see if they work for your situation. So the one we're going to talk about here is somebody has a better than average year. Now, not necessarily better than average. If every year is better than average, like if your average is better than average, then this will work as well, right? So if you're just generally someone who is blessed with a lot of wealth, this tool will work just as effectively. But in particular, if you have, this year turned out for whatever reason, you sold something, you got a bonus, business was good, then you should definitely consider this tool. So it's called a charitable lead annuity trust. So those of you that are familiar with, that have worked with us or that are familiar with estate planning concepts know that in this field, we love acronyms. There's an acronym for everything, right? So this one is a CLAT, not to be confused with a GRAT or a CRAT or like any of these other tools. a grantor charitable lead annuity trust. And what this is a trust that you establish, control, and get to invest the money. So this is really key because there's a lot of tools where, actually, I should go back to the previous version. You could just donate a bunch of money to the charity directly, right? But then again, you don't solve the bunching problem and you don't solve the annual continuous giving that you were hoping to do. So here, this is a very unique trust because in most irrevocable trusts, you have to give someone else the authority to make decisions for you. So if I want to set up an irrevocable trust for asset protection, for instance, I set up a trust, I name Aboud as the trustee, right? Obviously I can't do that within our own firm, but just, I name him as a trustee. So if somebody, for any reason sues me, I basically tell him, it's not even mine. You got to go talk to Aboud. He's not going to give it to you. He's not even going to give it to me, right? So that's like, it creates a layer, and it's a powerful tool, but it's one that a lot of people are nervous about because you're no longer in charge. This trust is super powerful because you retain control. So you can continue to invest the money however you want in whatever types of accounts you want. Now, there's some restrictions, of course, but generally speaking, if you're somebody who's investing in the stock market, in securities, in crypto, even in real estate, if the numbers are large enough, you can do this inside of a CLAT. So you set it up for a fixed number of years normally. You can set it up for life, but we usually set them up for a fixed number of years. I'd say the minimum is 5, but we typically do 10 and they go up to 20, or you could do it as a term for the rest of your life. And what you do is you basically tell the IRS, I promise to give a certain amount of money to charity every year. Okay. So I'm going to put $100 in this bucket, and I promise that I will give $10 every year for the next 10 years to charity. Okay. What the IRS says is awesome. In exchange for that promise, we're going to give you a deduction this year for that $100,000. Now, they're not going to give you the full 100 because you're not doing it today. You're doing it over the course of 10 years. So if you run the numbers, we just did this right before we got on, a 10% annual CLAT has a deduction rate of about 80%. Okay. So they're going to give you $80 deduction in exchange for that promise. Now, what happened? All you did was move the money from your right hand to your left hand, right? You set up a trust, you funded the trust with money or with cash or with stocks. Okay. So there's some work involved in the legal setup, as well as going and setting up the account, getting the EIN, going to the bank, all of that work, which has to happen, really soon if you want to do it this year. But then you're still in control. So you can now invest the money just like a brokerage account. Either you have a wealth manager, or you have, you do it yourself. You can set up an online account for the CLAT and you can invest the funds. And then every year you're going to make $10,000 payment. It's zakat, sadaqah, just general donations, whatever it is, each year to charity. Now, what's going to happen is you're not going to get the deductions in subsequent years, which is logical, right? Because you took them this year. So what did we accomplish by doing that? Remember, it was money. It's the IRS basically giving you back money this year that you would have otherwise had to pay in each year in tax. And that's assuming you're itemizing, right? If you're not even itemizing, this is even better. So think of it like an interest-free loan because you're getting a deferral here. You're also getting the deduction. Okay, so you're lowering your taxable income. And if you do it right, and we calculate everything effectively, we can actually drop a rate. We can drop you to a lower marginal rate so that you're also lowering your rate. So in essence, you get all of the concepts combined in this tool.
Not only do you go to a potentially lower tax bracket because you reduced your income by 100K, but there's another reduction of tax bracket in a different sense, in that you are so on one end you lowered your tax bracket. On the another end, this 100K, it's going to be invested, and then that 100K, which would have normally been taxed at ordinary gains, ordinary income, would be converted to capital gains. So that's a very kind of nuanced point, but a very, very important point, right? Like if you're at the 50% tax bracket, for example, now you're all the way down to potentially long-term gains, which is much, much lower on that 100K slice that you put in the CLAT.
No, that's a really good point. I missed it entirely. So yeah, so the the rate is lower because you lowered your bracket potentially, if we can do the math correctly, or optimize it, right? There's some estimations that you're going to make, but if we can get you down into the lower bracket, that's one thing. But if this is earned income, so you know who this works kind of best for, I think, is, I mean, it works good for a lot of people, but if you're a W-2 employee, right? So a lot of our clients that are doctors that work at the hospital don't have a lot of the opportunities to do the things in scenario 2, like defer income or accelerate deductions and things, because they're not business owners, right? So if you're a high income W-2 earner, or you are a partner, you're a partner in a partnership and you get a K-1, you really don't have the opportunity to do a lot. This is one tool that you can set up and take a very large deduction this year and convert that income to capital gains instead of ordinary income. And like I said, pay the tax over time as you realize those gains, as opposed to doing it all this year. CLAT differs in that profits from investments come back to you. Yeah. So the key difference, Arshad, between what we talked about here in scenario 2 and 3, I talked about a DAF, and a DAF is powerful, right? But it's like a simple version. This version, the key benefit, and we're going to show you a little bit of the numbers to kind of make this more real. You get the upside. So whereas in the DAF, if you put $100,000 in, you'll get your $100,000 deduction, but you'll never see that 100 again, right? The charity will see it. In this scenario, you put the 100 in, and if you invest it and you pay 100 over the course of 10 years, at the end of 10 years, if you were getting a 7% annual return, you're going to double your money, right? So you're going to get that back at the end of the term. That's why it's set up for a number of years. So this is really, really nice to set up for a fixed number of years when you know that I'm going to either retire or I'm just going to have this, amount of money coming back to me. And then we can set up another one then, if you want to get the deduction at that time, or whatever the case may be. Abud and I were talking about this before we got on. And one sort of frame for this is kind of thinking about it like an IRA, right? Or like a 401k. When you donate and when you fund that vehicle, you take a deduction this year. And so your accountants will often tell you max out your retirement accounts, because you'll be able to lower your taxable income this year. It's a little short-sighted because you're not going to be able to touch that again until you turn 60, oftentimes until you are required minimum distributions when you're 72. This is a tool you can do for like 5 years, 7 years, 10 years, right? And time it so that you get some money back when your kids are going to college or when you plan to retire or whatever the case may be. So we like it. So let's talk a little bit about mechanics. We're at 647.
So I just kind of want to underscore what the CLAT did, because I saw a question here. I tried answering it in the chat, and Yasser just answered it, but I want to underscore it so everybody understands what happened here, right? You have two, let's compare two different paths. Path number one is you give 100K to charity over 10 years, and you do it just like you're doing it today, right? Which is basically no planning. Path number two is you plan for that 100K over the 10 years through a CLAT. And if you do it that way, not only will 100K go to charity, but you will potentially generate an extra 100K of wealth, assuming the money doubles, considering a 7% growth rate on the funds they're in. So to be clear, it's like, imagine the CLAT as another like sadaqah jar. That the funds in that jar are being invested. And then every year you're taking from that and giving to charity, just like you do today. But instead of coming from your normal bank account, it's going to come from your CLAT brokerage account.
So awesome. So I want to go over a little bit of just kind of help you understand this concept, and then we'll talk. We'll show you some numbers just to kind of make it more real and help you understand the variance of this thing. These are tools, by the way. We're not talking today about tools that are like on the IRS like red flag list, right? There's certain things that if you go look online, there are certain techniques that are out there that'll give you these giant deductions, but they're also likely to trigger an audit, right? So things like conservation easements and captive insurance companies. Some of you have them, some of you are familiar with them. That's fine, right? Those are risky techniques that exist out there. A CLAT is actually something that the IRS has approved itself, and it has been in existence for a while. It's just not, it's the least utilized charitable technique. And I think in part because, the general public is not as charitable, right? So this isn't a tool, this tool relies heavily on charity. And so you have to be convinced about charity in order to start the process. And that's why we're talking about it today, because we think within our community, it's such a good tool because everyone's already charitable, right? As opposed to some other techniques, which we're not talking about today, which are not tied to charity, which still generate deductions. So let's talk about the mechanics here. You set up a trust, okay? You set up a CLAT. You can do this any year. We have some clients who set them up every year, right? Multiple CLATs running consecutively or concurrently, if you will. You can fund it with cash or stocks. So you could take money that you already have in a brokerage account. Let's say you've got, $500,000 in a brokerage account. You could take out 100 and transfer it into a charitable lead trust. Just by doing that, right? Just simply by setting up and moving, you're going to generate this large deduction for yourself this year. Okay. Of course, you're going to promise, and this promise is binding, that I promise, and you sign it and you tell the IRS, I'm going to give this money to charity over the course of the next 7-10 years, right? Whatever the terms that we set it up for. Now, the beauty here is that you get to invest these assets, right? And again, investments are risky. Like, we're not investment advisors, right? We're not going to tell you how to invest your money. People are talking about the markets are going to go down and every day is a different, nobody knows what's going to happen. But the investment risk is present in any investment. So this isn't unique here that, what if the markets go down? Well, what if the markets go down? Yeah, the markets will go down in any scenario. But you promised to give that portion to charity, so we have to structure it in a way that allows you to fulfill
equally
that.
risky in your 401k. So
yeah, for sure, exactly. Yeah, so I mean that could also go down. Here, the thing is, you promised to make the payment to charity, so it has to go to charity. So we have to run this. For instance, if you set up a CLAT for 3 years, it's probably not a great idea, because if in year 1 there's a crash, you're not going to be able to recover and make the payments. And then you're going to have to pay the government back the money that you promised that you got as a deduction. So the minimum term we would run this for is, say, 5 years to account for a dip, right? Even if there's a dip, we assume that it'll come back and we'll be able to recover. So you make your annual donations to charity. Well, you were already doing this, right? So again, if you're someone who's already giving, like, nothing's really changed except the framework, the structuring. And then at the end of the term, you'll get back whatever's left, okay? So if it's nothing, it's nothing. But if it's double, triple what you put in, you get to take advantage of that. So let me show you a couple numbers here to give you kind of a sample of what we're looking at. Okay, so let's say we set up a 10-year CLAT, okay? We set up a 10-year trust in which we promise to pay $10,000 a year to charity, okay? And again, this can be the floor. If you're somebody who gives 30, 50, whatever, you could assume at least I'm going to do this much, right? And we can play with these numbers. So assume you get a 6% annual return on this investment. In year 1, you're going to get $81,000 the government's going to give you back. Lower your actual $81,000. Lower your taxable income by $81,000, okay? And then that's dollars in hand of, 32,000 if you're in the 40% bracket, okay? You invest that money, you get a 6% annual return, you're going to get $47,000 back at the end of the year, at the end of year 10. Let's make it 7. Let's make it 10, right? You get 100, right? If you can see there's a 4% annual return, you're going to get 27,000, right? So that just gives you an example of how this works. Now, what if the market's going down? One strategy here is to give less in the beginning. So you start to backload it. And if the purpose here is it's a half investment tool, half charitable tool. That's why we love it so much. So you can basically put less in the beginning. And if you go up 20% every year, you'll see the total amount is still 100,000 that you're giving to charity. But at the end here, you're going to get 34,000 instead of 27,000. What were we budgeting? Let's budget 7%, right? Let's make it 6. Okay. So we went from 42,000 to 57,000 as the return amount. Now, if we go to a more backloaded version, here you'll see we decided to be aggressive. And we have a number of clients that like this structure the most. Okay. It's called a shark fin. It's like this really, it's supposed to be modeled like a shark fin, but it also has this, this name that just kind of gets you. So let's assume you give $1,000 in years 1 to 9 and 91,000 in year 10. Okay, so now you're going to say, well, I don't have 91. What kind of big charitable gift am I going to make in year 10? Well, you figure that out later, right? Maybe it's a DAF, maybe you're going to fund some, awesome project for the community, whatever. What's going to happen is that you're going to get at the end of it $75,000 back as opposed to 47. Now, if I went over here just for a minute, what that means is if you combine the return on the investment plus the amount that you saved in taxes, real dollars, at the end of year 10, you would have given away $100,000 to charity and you would have gotten back in total $122,000, right? Now, if you're someone, just to push this one step further, if you're somebody who doesn't itemize, you give $10,000 a year to charity, the net here at the end of year 10 that you're going to get back is going to be zero, right? You're not going to get the deduction, right? You're not going to get, because you weren't getting the deduction anyways, right? The government wasn't giving it to you because you were itemizing. So there's an incredible opportunity here. Now, if we change this number, for instance, from 100 to 300, you can see, how these numbers start to grow, right? In this $300,000 scenario, you put in 300, you give away 300, you're left with 234,000 at the end of year 10. So it's a really powerful tool. The intent here is not to get you too caught up in the numbers, but to present like really the fact that these numbers are really, really powerful within this tool. Abu, you got anything else?
Yeah, we have two questions here. What happens if the amount fails? And then what type of assets? Do you want to just go over that real quick?
Yeah, so maybe that's a good segue to the next slide here, which is there's a risk. I mean, any structure has a risk. This is more just of an investment risk. It's not a risk of like the tax structuring itself. It's a risk of the structure. So you have to be intelligent. So if, for instance, you set this up and we run it for 10 years, but you put all your money into Bitcoin or like some altcoin, and you thought it was a great investment, and it goes to zero. Well, there's a problem, right? You took a big deduction and you didn't pay any of it to charity. So there's going to be an amount that you have to pay back. You can't fund this thing with more money. If you want to set up another trust next year, you can set up another one. But if you run out, there's going to be a recalculation for all of the money that you should have paid in tax and you didn't. So that's the risk. Now, how do we control for that risk? We control for it by A, running it for long enough, and B, not being like dumb with super risky investments. Like, this is a tool that you're not going to go and make the riskiest investments you have. Like, but you can make reasonable investments here with some amount of risk involved, just like anything else. Okay, so that's how you'll kind of.
And I'd like to underscore, like, really think about it as a 401k or an IRA, but you're paying your charity from the account, right? So try to be reasonable in terms of the investments.
Okay. Yeah, exactly. You got to be smart here. Buying a car, you got to talk to the CPA about that. We're gonna stick with CLATs right now. So I will just tell you just one little thing because I was looking into it myself.
But sorry to cut you off, Yasser, but there was another question about the type of assets that you can invest in. You can invest in real estate and other things, but here you got to think about the time horizon, right? Like, if you're going to do real estate, maybe you want to think about. I'm not a real estate investor, but you might want a longer time horizon. So maybe you set the CLAT up for 15 years or 20 years, just in case.
Yeah, the risk with the real estate for our clients that want to do real estate, the risk is, remember, you have to make annual payments to charity. So if you tie up your money in illiquid asset, you can't make the payments to charity, and the payments have to come out of the trust. You can't say, I'll do it out of my other pocket, right? So you've either got to have enough rental income to make the charitable payments, or you backload it such that, when you realize the gain on the sale of that asset, then you can make the large payment to charity down the road. This is actually a really, like, it's in essence like a self-directed IRA, right? So you can utilize it for real estate. Again, so subject to the same restrictions of the IRA and the private foundations. Like, you can't buy your house inside of a CLAT, right? Like, there's basic rules that apply. So who's a good candidate for this one? I would say if you give $20,000 a year to charity or more, you're probably a great candidate. And these are just factors, right? Like, we're just trying to make it easy for you to think about like who fits into this box. Adjusted gross income, $250,000 a year or more, probably a great candidate. Again, if the numbers are lower, they might work as well, but we're talking about who's a great candidate. There's good candidates as well. And then you've got to have money to set aside. This is not just a promise, but you have to actually set aside the money. So you have to either move money from an existing bank account or a brokerage account or some asset that you sell or some bonus that you're going to get. So again, the minimum I think that makes sense here is $100,000. Why? Because there's legal fees to set it up and there's some compliance costs to run it. So you're going to get a massive deduction, but you want to make sure that it's worth your while. We've done them with smaller amounts, I will say that, and we've done them for shorter terms. So for the right person, it might make sense to run smaller, shorter terms as well. But the best case is if you had a large capital gain event, you sold something maybe earlier in the year before the real estate market like started tanking, you sold your house or you sold something. So you want to realize it, you want to offset the gain from January or February, above average income year or Roth conversion this year. Oh, this Roth conversion point's really interesting. I mean, we only have 2 weeks left. So I will say everything we're talking about is stuff you have to do before December 31st. Except this one. This one you got to do like in the next week or so. And the reason is you have to set up a trust, you have to sign it, execute it, get a tax ID number, go to the bank, open an account, fund the account. So there's like some steps that are required and you just might run out of time. So if you're interested, I would say definitely reach out to us soon so that we can get that part going immediately if it's something you want to do for 2022. And this Roth conversion point was maybe you deliberately realize gain in the Roth conversion and then you offset it with the deduction here in the CLAT. So like we're talking like compiling advanced strategies with each other to really like zero everything out in a really powerful manner. So that's
I want to underscore that the 20,000, giving 20,000 a year to charity is not like the minimum by any means. It's just a number that we threw up in the original example. It was $10,000 a year in charity for 10 years. So, it just depends on your horizon and all that. But the main thing is if you're giving a significant amount of money to charity consistently every year, this could be very interesting.
Yeah, I mean, that's a great point. My example itself was 10,000, right? So I put 20 here again if it's the optimal client who gives more than 10, but really there's an opportunity here for someone who doesn't itemize to really take advantage of setting this up instead of doing a DAF. And there was a question, I'll just pause on this point. There was a question about the Sharia compliancy of a DAF. There is some question about like who is the owner of the DAF and what happened because you gave money to someone else it's not your money technically anymore. Here you don't have those problems. You don't have a problem with the Sharia compliancy of the investments because you control them, right? So if you set up a Fidelity DAF tomorrow or Schwab DAF, the concept makes sense, but you're not going to be able to control the investments. Here you can control them and put them into whatever Sharia compliant investment you want. And also you still control it. So it works both as a zakat tool as well as a sadaqah tool.
There's a question from Arshad regarding cost range of setup and operating cost.
Yeah. So typically I would say the cost to set up a CLAT is usually somewhere between 4,000 to 5,000 or 6, 7, 8, depending upon how complex you're making it. Maybe 4 to 8 is like a fair range. Depending upon, like I said, if it's backloaded and what's involved. In terms of the annual cost, there's a tax return that's due. So, it's just accounting fees. And so those can be worked out. I mean, they're not
technically
zero.
You can learn to do it yourself, but yeah, if you want to have an accounting.
Zero, but they're not like, it's not thousands of dollars a year in compliance. But I would budget a few $100s definitely every year. In compliance costs to make sure that the tax return's filed. And then the rest of it you can do by yourself. Like you're going to cut the check from the CLAT account to the charity, right? So you're going to, direct it online or whatever the case may be. And then the gains that you realize are taxed to you personally on your personal return within the trust. So there's accounting fees. That's why obviously the larger the amount you fund this with, the more it makes sense. But on the front end, it's a one-time setup fee. That is typically somewhere between 4 to 8, $4 to $10,000, depending upon where you go. So in our case, sometimes it's a little bit lower depending upon what the numbers are and what's involved. What about filing taxes for the trust? Yeah. So that's what I said. There's a CPA or a CLAT administrator who's going to be doing that for you typically, right? And we work in conjunction with the CPA, and we we can help with that stuff as well, and kind of identifying and creating the relationships if necessary. So so that's that. If there's more questions, you can keep putting them in. We'll stay for a few more minutes, but like officially, I wanna say thank you for joining us. This was, for us, it was fun, and hopefully it's hard. We can't see your face, but hopefully you found it interesting, beneficial, informative, semi-entertaining. And if you want to take any of the next steps, in particular, I would say if you're interested in setting up a CLAT this year, then definitely reach out to Abud, to myself. You can call the office, you can reach out via the number on the screen, and we can set that up for you, that consult, and talk more about numbers, talk more about your situation, see if it makes sense. And if there's other stuff that you want to talk about, whether it's trust and estates, or tax strategy more broadly as well, we're happy to chat and to assist.
Okay, so we'll officially, the webinar has ended, but like Yasser said, we will stay on for another few minutes. For though I see more questions in the chat, we'll try to go through them. So feel free to go have your dinner, or talk to your family, or whatever you have going on in life, inshallah. And then for those of you that want to stick around for some questions, feel free to do that too.
Okay, so yeah, so we'll keep talking for the next 10 minutes. If anybody has more questions. So what I will say, there's a couple really good questions. A lot of people have been asking about the presentation. So what we'll do is, I would say send us a note, and we'll send you the link. I don't want to spam everyone, but we'll send out the link for the recording. It is being recorded, so we can share that with you. Again, if you want specifics about the CLAT and stuff unique to you, and you want to set it up, you got to reach out to us. Amadel, yeah, please send us an email so we can make sure to capture that. This is a good question, anonymous attendee. Two questions, I think, as reading two different chats, but one was, can we do this anywhere in the country? And the answer is yes. So this is federal tax planning, right? So doesn't matter where you are. I know a lot of you have reached out with regards to estate planning, and we said, hey, we're not in your state, unfortunately. You have to have a local attorney. Here we can work with you regardless of which state you're in. Can the charity be selected at the time of the donation each year, or is it defined when the CLAT is established? That's a great question. So one of the beauties of this thing, and this I think also ties to Zohaib, your question. So let's say you're on the board of an organization of a masjid. You can pitch this. I think it's amazing because you can build an income stream for your masjid, right? Instead of every single year being like, Brother Abud, can you please give me $10,000 or whatever? Just lock him into like 10 years to 10K, right? Like, this guy's been giving, get him to promise it and pledge it and do it. Okay. Now that said, he's allowed to change the beneficiary, which makes it nice for him too. So he makes this promise, but if for some reason, the new board comes in and he doesn't like the new board president, or whatever the case in every masjid politics that we unfortunately deal with, he can change the charity. So that's why, again, this is so powerful, because the grantor, the person who sets up this trust, reserves the right to change the charitable beneficiary. So you can set it up, and you can also change the charitable beneficiary. The allocation between them, say you want to split it between 3 organizations. You can also couple it with the DAF. Okay. And again, back to the DAF, like I think DAFs are powerful. You can couple it with the DAF. The question is more so about zakat, but not about sadaqah. Like, you're good, right? So you can couple it and make that big, large payment that, let's say, is due at the end to a DAF, and then run your charitable donations out of there after that. All right, Abud, am I missing? I'm trying to run through some of these. You had.
So here's another good question. Does the CLAT donation reduce your AGI? We didn't really talk about AGI yet, but this probably is a good time to do that.
Yeah. So I mean, yes. So the CLAT is a charitable deduction, right? So it's just like any other charitable donation. It's going to lower your AGI. It's an itemized deduction, right? So it's going to lower your taxable income. And you're going to get the deduction is going to be based on the present value of the future payments to charity. So if you gave $100 to charity or $100,000 to charity this year, you get a $100,000 deduction. But if you gave $100,000, splitting it up 10,000 every year for the next 10 years, you're going to get that $81,000 deduction. That's based on the effective interest rate for the government, how to calculate it. So we're actually using the interest rate of October. And don't get confused when I say the interest rate here. This is just a government rate to calculate what the deduction is worth. So as the rates go up, the value goes down. They're inversely related.
And that Tanzil asked a question about the maximum deduction that you can take, and that there's another element to AGI that relates to that question. Do you want to answer that real quick?
Yeah. So I think what she's talking about, I think what she's talking about here is there's a deduction limit. There's an AGI limit for the deduction.
Correct.
So yep. if you are giving if you are donating cash, the deduction limit is going to be 30% of your AGI, and if you are donating stock, securities, basically, then the deduction limit is 20%. So again, this is tailored to your specific needs, right? So we got to look at what's your AGI going to be, and we got to estimate, right? And we do this in collaboration with the CPA. So we figure out, you say, I have taxable income, adjusted gross income of $300,000 this year. Okay, so that means we're going to say, let's set up a CLAT with a maximum deduction of around $100,000, right? We want to create a deduction of around $90,000 for you this year. Okay, and then if we did more, it's going to carry forward to future years. So it's not a big deal, but we want to try to optimize. We're always about getting the maximum that you can do this year. So for you, if you're $300,000 AGI, you want to do $90-ish thousand or $100,000 to charity in the CLAT this year. And if someone's, again, we can do the math and figure out what's the AGI and what's the number for each person. CLAT payments to charity count as zakat if you are getting profit back at the end of the CLAT. Yeah, so it's irrelevant that you're getting money back at the end. You're giving the money to charity. Imagine you didn't have the CLAT, right? So if you gave money, you took $10,000 out of a brokerage account and you gave it as sadaq, as zakat, right? It's gone. That money's never going to come back to you. So you calculate what your zakat is. And if anyone has no idea what zakat is on the call, we've gotten into a lot of like deep Islamic technicalities in addition to tax, but it's fun. So that's the donation. It's irrelevant. It's just that the bucket that you're operating in is also an investment vehicle. So the profit is on the part that's not donated, right? So I don't think there's any type of problem there.
Yeah, and what that'll do is it'll actually hopefully increase the zakat amount you'll have next time, because now you have more wealth from which you're paying zakat.
Yeah.
Remember the way to think about it is, I'm donating just like I am today versus I'm donating out of this sadaqah jar, right? That's really you're doing the same thing. It's just that the IRS, if you donate it from the sadaqah jar, the IRS gives you benefits for doing that, incentivizes that way. Now, the interesting thing is for us, they're trying to incentivize someone who's not charitable. We're charitable oftentimes by requirement, right? With the zakat, if sadaqah, it's out of goodwill, but it's just more of a shifting of the framing. Think of it that way.
Yeah, and I would just say that inside of the sadaqah jar, since we're sticking with this, there's work happening, right? Like the sadaqah jar is like creating more sadaqah and money, but
that's right.
But the thing is, you get some of that sadaqah jar money back at the end. Like you give your kids back some at the end, if you will. So yeah, I think I hope that's again, we're talking are you not titled to 160% of AGI limit for a DAF? How about for a CLAT? No, it's 30% for a CLAT because it's a trust. So there's a different AGI limitation on the CLAT as opposed to a DAF, which is a charity itself. So it's a different, and it makes sense again because you're going to get some of that money back. So they're going to lower the amount that you could put into it versus the DAF, which you don't at all. So from a FIC perspective, I personally like the CLAT much more because you have so much flexibility, so much control that you exert over it. Also, it's easier to put more money into this thing because you're going to get it back at the end, right? It's not all just going out of your pocket. So we'll stop here. I will again just reiterate, if this intrigues you enough to want to set it up before the end of the year, then please reach out to us very, very soon because we really don't have much time. If the rest of the tools are helpful and beneficial to you, then that, hopefully you could take something away and save money. The crypto rule is a really important one. If you've got crypto and you're sitting on losses, that, hopefully that advice, if you hadn't heard it before, could save you tons and tons of money. So definitely I would look into that and make sure you do that before 12/31. Besides that, this was our first time doing this and it was pretty fun. So if you have thoughts about, what other topics you want us to talk about, we can set these up. We'd love your feedback, how we can improve, how we can help you learn more, and how we can help the community grow. Just let us know, inshallah. Any closing thoughts, Abu? Good.
No, that's it. This was fun. I hope it was useful. It was fun for us. Fun for me. I should speak for myself. And I hope everyone got something out of it today. And definitely, if you have feedback, please do send it.
And we'll send out a survey. So please take a few minutes to fill out the survey so that we can just get your feedback, right?
Yes, sir. One more thing. I still see some questions about the recording. Can you just make one final statement about the recording before everyone signs off?
My one final statement is this is my first time doing this on Zoom. So hopefully after we get off of here, we'll figure out how to get the recording and we'll send it to you guys, inshallah.
All right.
We did click the button to record it, and I'm assuming that it is being recorded. So
inshallah.
Hopefully hopefully that's the case and the recording will be shared. If not, we'll do it again. All right.
All right. Assalamu alaikum, everybody.